So I said, sure, I'll tell you the monthly returns as they come in. And sure enough, after the first month that this fund had money with us, we reported back that we were up 1.1%, which we thought was pretty good. But I got a call from the fund of funds and said, well, we have a lot of other managers that do similar things to you, and the average one of those was up 1.2% last month. To what do you attribute your underperformance? And I politely told the fund of funds to call me back in a year. I probably should have told them to call me back in 4 or 5 years, but I don't think they would have stuck around so long. So I figured I'd settle for 1 year. But the world has become much more institutionalized since then. People look at daily returns, weekly returns, monthly returns. They get analysis over the month or the quarter. It's very hard to keep a long-term horizon when you're investing in the stock market. 4 or 5 years is a more reasonable time frame to judge anyone's performance.
So you get hyperactivity, which research shows does not lead to better returns.
Exactly. So what happens really is that if you underperformed in the last 6 months, year, or 2 years, people chase performance. So they take money out of you and put it into someone else. And another statistic I wrote in the book, which I think is the most telling, is if you look at the top performers over the last decade, the top 25% of managers that have outperformed, came up with the best record for the last 10 years. 97%, 97% of those top managers spent at least 3 years in the bottom half of performance. 79% spent at least 3 years in the bottom quartile of performance. And almost half, 47%, spent at least 3 years in the bottom 10% of performance. So all their investors left if they did that, but these are the ones who ended up with the best long-term record. Most people leave them. Most people don't stick around for long enough. One other thing I write up was the top, in the decade of the 2000s, that 10-year period, the top performing mutual fund was up 18% a year. The average investor in that fund lost 11% a year. That was the best one. Why is that? It's because every time the fund underperformed, people left. Every time the market went down, people left. Every time it outperformed, people piled in right after the outperformance. Right after the market went up, people piled in. So with all the investors' market decision, the average investor, average dollar-weighted investor in that fund over the last decade, the best fund, ended up losing 11% a year.
You make the point that if you go for value, and we'll define your definition of value in 1 second, over the last 10 years, 600-700 basis points above the S&P. Are you guilty of rearview mirror investing, saying what worked in the past will work in the future? We know with money managers that doesn't work.
Right. Well, if I had spun the computer 1,000,000 times to figure out what might have worked, that is true. But we have a couple simple factors that we use. That's the way I invest in individual stocks. It's really looking at how much cash flow do I get for the price I'm paying. I don't use simple earnings. I use our own definition of cash flow. I don't use simple price. I use something called enterprise value that we make all kinds of adjustments for debt.
Let's go to that. Define what you call price to cash flow.
Well, in the last book I wrote, I used EBIT, earnings before interest and taxes. For our new mutual funds, we actually go figure out what the real free cash flow is. EBIT was a proxy, and it worked quite well in back testing. We actually do the work ourselves and figure out what real free cash flow is. So if we have pension liabilities or tax assets and tax liabilities, we just really pick it apart. But the concept is very simple. It's, what is the real free cash flow of this business? And we're not looking forward. We actually look backwards. So we can talk about that in a second. How can you make money by looking backwards? Because the value of a company comes from its earnings going forward. So if you have something that you can look at history, right? Reading history books shouldn't be able to make you money. Well, here we're just using simple factors based on what's already happened. And we can talk about in a second why that works. But we're looking at trailing free cash flow to the price we're paying, the all-in price we're paying, including all the liabilities of a company. And the other thing we use in the mutual funds is really just our definition of return on tangible capital. And if you read through all of Warren Buffett's letters, he really focuses very keenly on how good a business it is. And one of the factors that he looks at, most importantly, is a business that can earn high returns on tangible capital.
Explain why looking at the past is predictive of the future, and then get to the number of securities you should hold. First, why is the past predicting the future?
Right. That's actually a wonderful question, and frankly, a very logical and obvious question to ask. How can you look backwards and then figure out what's going to happen in the future? And in fact, we're really not doing that. What happens, we were talking about before, is how people have a very short-term horizon. And the big secret for the small investor is that they can keep a long-term horizon. So why would the market allow us to buy a company cheap relative to its earnings? We called it an earnings yield. In other words, why would we get a 15% earnings yield from one company and only 5% for another? Why is the market giving us this bargain? Generally, the companies, if you look backwards, that earned a 15% earnings yield, most people don't think that'll continue in the future. At least the next year or two won't be as good as the most recent past. And so they're willing to sell it to you cheap relative to its past earnings. So they think the next 1 year or two will be down from where it is. So they allow you to buy it at a bargain relative to past earnings. So these are you're buying all out-of-favor companies. They earn high returns on capital. You're getting a high earnings yield, but people are worried about the next year or two that they won't be as good. So they discount.
So Obamacare comes along, dump the healthcare stocks.
That's a perfect example. Healthcare stocks show up on our list now because everyone's worried about what's going to happen, under Obamacare. All kinds. We have a company called GameStop that keeps coming up on our list because everyone thinks it's the next Blockbuster. They sell games.
So look at the news and companies that look like they're going to get a hit.
Well, we really do it by we really do it by the numbers. So if you get a high earnings yield now, that means there are very low expectations for the companies that you're buying. Even though they're getting high earnings yields, there's low expectations for the future.
So you're not buying a company that's going broke.
Exactly. You get high free cash flow now. You think the next year or two might not be as good, or there's a lot of uncertainty. So you buy them with low expectations built in, and if they do a little better or a lot better, you have the chance for asymmetric returns on the upside. And those are precisely the stocks that institutional managers who worry about doing well in the next year or two systematically avoid and overcompensate for that because they don't want to be there. So if